Unit 1, Business, Bookkeeping, and Accounting. Unit 1 focuses on business, bookkeeping, and accounting, and it looks into the business in Southern Africa. And we've got business in Southern Africa as well. And there are steps in starting a business. Which step 1 is choosing an appropriate form of business ownership. So you have to think about what type of a business you want to establish. Maybe you want to become a sole trader, a partnership, a company. Step number 2, you have to register with all the statutory and regulatory bodies. The statutory and regulatory bodies refers to all the acts of parliament and policies that have to be complied with when it comes to registering a business. Step number 3, when starting up a business, one has to acquire assets. You have to buy machineries, equipment, stock, and vehicle for you to be able to run your own business. Step number 4, you have to purchase stock, which is an inventory. And inventory is the one that keeps the business running on a daily basis. So for you to be able to run and make profit, you have to buy stock in order to make profit. And then number 5, you have to start trading. Trading with the stock that you bought. Then accounting is also part of our Unit 1, which is a language of business, which involves bookkeeping and accounting cycle. And bookkeeping involves recording data, collecting and analyzing data for business purposes. And movement under the accounting equations falls also under part of our Unit 1. And our main aim is to make profit. A profit motive, which is highlighted by the income and expenses. For you to make profit, you have to have an income of which you have to deduct your expenses for you to make the net profit, or else it's the net loss. Moving on to Unit 2, bookkeeping still. Value-added tax and source documents. Value-added tax, as well known as VAT, is a tax that is levied on all goods and services provided, and some goods and services are VAT exempt, which means some goods and services are not taxed at all. There is no tax applicable to some goods and services, and those goods are called exempt supplies. They are not taxable. VAT vendor refers to the person or business that is registered for VAT. A VAT vendor refers to someone that's registered for VAT. VAT returns refers to the summary of all VAT transactions which took place in a business during a specified period of time, and which will show the amount of VAT input paid, output received, and the difference between the two. How does the VAT system work? A VAT is charged on goods and services, and in Namibia specifically, our VAT rate is 14%, which is charged on goods and services. For those non-exempt goods and services, but for exempt goods and services, we said we don't pay tax at all. Example, Mr. P sells cream at $10. The price inclusive VAT will be $11.40, which is 14% of the $10 will be $11.40. So VAT output payable will be $11.40 minus the $10. So the VAT output will be $1.40. VAT supply categories. We have got the standard rate supplies, zero rated supplies, and exempt supplies, as I mentioned already. The standard rate applies is the standard rate of tax that's applicable to certain goods and services. Certain goods are also taxed at zero-rated supplies, and some goods are not taxed at all, which are referred to as exempt supplies. Non-allowable items. These are goods and services which the vendor charged output, and the acquirer of the goods and services might not claim VAT output on them. These goods and services, the vendor, the person that's registered for paying VAT or value-added tax, might not claim VAT input on them at all because they are already charged tax from the person, from the moment they were acquired. They include entertainment expenditures, passenger vehicles, and club fees and subscriptions. Those are our non-allowable items, goods that are not taxable. Then payment versus the invoice basis. If a business is registered on a payment basis, credit sale is made to a debtor, and the business need only to record the VAT on the sale as owing once the money is received from the debtor. This means that the VAT output is not recorded in the tax period of the sale, but rather in the tax period in which the money is received. That's the payment basis. While the invoice basis, when a credit sale is made, the business must record the VAT, the value-added tax due, and the vendor must record the VAT output in the tax period, and the sale took place, and pay over the value-added tax on the return, and the return on the return submitted. Okay, it's Unit 3. Unit 3, recording cash transactions. We're defining cash. Cash transactions refer to all the transactions which are settled at the point of sale, and they are classified into two categories such as cash receipt transactions and cash payment transactions. Cash receipt transaction refers to transactions in which cash is being received, and the cash payment transactions refer to the transactions in which cash is being paid. Cash money is flowing out of the business, and while the receipt one is money is flowing inside the business. And we have got the cash journals, which are books of first entries for recording cash transactions. We have got the 3 journals, bookkeepers associated to record cash transactions. We have got the cashbook receipt, in which we record the cash inflow or the inflow of cash, and the cashbook payment, in which we record the cash outflow or the outflow of cash into the business, and the petty cash journal, in which we record small cash outflow payments. And the cashbook receipt. A cash receipt transaction is any transaction which causes an increase in the bank account balance. Example of a cash transactions include capital contribution. We all know what capital is. Money that the owner contributed into the business for setup. Capital can be in the form of cash, money that the owner bring into the business, can be in the form of a vehicle that the owner brought up as part of starting the business, or it can be the form of skills that the owner will use in starting up a business as well. So, cash transactions also include cash sales. When we are selling goods on cash, cash will be coming into the business, and it also includes services rented. When we rent our services to our clients, so cash will, when they are paying us, so cash is coming in the business as well. So the forms of cash coming in the business, as well as rent received, renting out a premises to a tenant. So money being received is also cash coming into the business. Then interest received on the bank account. When you have your money on a fixed deposit, let me say at FNB or Standard Bank, the amount of interest that you are earning as part of agreement between the customer and the bank, the interest that you are going to earn is also cash coming into the business. and the amount received from debtors. So the people that owes us money, we call them debtors. So when they pay us money, so cash is also coming into the business. And the cashbook payments refers to transactions that causes a decrease in the bank account balance. Examples: drawings, acquiring assets, joins. Okay, let me just briefly say something about drawings. Drawing refers to the money that the owner takes into the business for personal use, which simply means when one owns a business, so if that person feels like taking money from the business to be counted in a separate account as drawings but not cash anymore, to form up a separate account. Okay, money also flows out of the business which is recorded in the cashbook payment by means of acquiring assets by check or through an electronic funds transfer. When you acquire an asset, let me say machineries, furniture and vehicles, by means of a check using the business's bank account. So money is flowing out of the business, and business paying for expenses by check or by electronic funds transfer, as well as when you are paying for our expenses such as electricity, rent, fuel, transport, and payment to creditors. When you pay our creditors, people that the business owes money, money flows out of the business and we record it in the cash book on the payment side. Recording credit and sundry transactions. Credit transactions refer to any transactions of which payments are deferred. When we talk about deferred payments, we refer to the payments of which transactions are made now, but the payments will be made later, on a later date. And you have got a debtor, which is the person or a business that owes the business money. And a creditor is a person to whom the business owes money. So it's vice versa. Benefits of credit. Benefits of buying on credit or giving credits to our debtors are more sales revenue. The more we are giving credit to our customers, the more we are giving credit to our debtors, the more we are given credit by our creditors, it's of utmost benefit to the business. If the business is giving credit to customers, the business can charge interest on those customers, which is the revenue to the business. And when they are going to pay, they are not going to pay the exact amount compared to the amount that will be paid on a point of sale, like on a cash sale. They will be paying that amount plus interest. And also when the business is owing creditors. So if we owe creditors, they are giving us a time limit of which to get enough money in order to be able to repay that money back. So that time limit that you are being paid, that time limit that you are having that money in our hand, in our business, we are making use of that cash, and it's of utmost importance to the business. Like it's part of the cash flow, business cash flow, and a repeat business. So it's as I said already, credit given to the business just allows the business to function well, like in terms of its cash flow and revenue. And we have got subsidiary journals for credit and subsidiary transactions. You have the subsidiary journals are debtors journals, the creditors journal, the debtors allowance journals, the creditors journals, and the general journal. The debtors journals, we record the credit sales we only record credit sales transactions. The creditors journal, we record credit purchase transaction, and the debtors allowance journals, we record the debtors allowance journal, we record the credit sales return. when customers return goods into the business, maybe they found out that this goods is default, or maybe it's broken, it's not according to specification, it's somehow not of the quality that the customer wanted to. So when the moment they'll be returning those goods, we are not going to record those in the debtors journals, but in the debtors allowance journal. It's also known as a debtors return journals. And the creditors allowance journal is where we record the credit purchases return. When we buy from our creditors, manufacturers. So if we return goods to our manufacturers or traders, those goods are no longer going to be recorded in their credit in their credit purchases book, but in the credit allowances journal as an indication that they are decreasing the business's account because we returned goods. And the general journal. So we mentioned that cash receipt and payments are recorded in the cash book, and small cash amounts are recorded in the petty cash, while the credit sales and credit purchases and credit purchases and credit allowances returns for both sales and purchases are recorded in their separate accounts. But there are certain transactions, let me say interest on our overdue account may be mistakenly recorded on the interest received account. That transaction doesn't fit in any of these books, so there is a general journal in which you record all those transactions which do not fit into other journals. Such as, let me also give an example of drawing of goods. If the owner of the business drew goods into the business, that transaction is being accounted for in the general journal. And Unit 5 focuses on inventory systems. Unit outcome. Perpetual inventory system. Perpetual inventory, a system of recording inventory and allows for a continuous updating of balances. Technology made it easy to update inventory levels in real time. Perpetual inventory system of recording inventory allows for continuous updating of balances, which means inventory being recorded on a continuous basis. When inventory is being bought, when customers are buying, inventory is being recorded by means of a computer. And as technologically wise, it's quite easier for a business. It's no more man-made that a person has to take a pen and write, but it's made by the computer that is just counting stock that is going out of the business and stock that is remaining in the business. The computer updates the balance of all inventory items. The computer then, after all, updates the balance of all inventory items in the business. And cost of sales can be determined at the point of sales. Cost of sales or cost of goods sold can also be determined at the point of sales using the perpetual inventory system or the continuous inventory system. We also have the periodic inventory system. With the periodic inventory system, however, in using the periodic inventory system, the flow of inventory are not recorded at the point of sale. The flow of inventory are not recorded at the point of sale, but value of items sold are determined when stock takes are done. The flow of inventory is not determined at the point of sale, but they are determined at the point of which people will be doing stock taking. That's how we determine the flow of inventory. And then we have got cost of sales is determined at the end of financial periods. Cost of goods sold using the periodic inventory system, unlike the perpetual inventory system, which is determined at the point of sale, it's in the periodic system, it's determined at the end of the financial period, which is at year end of the business financial period. And cost of sales is determined as follows. We got opening inventory, opening inventory, you plus purchases, you plus purchases, you plus again in, carriage, carriage inward, carriage inward, carriage inward, which can be carriage inward. You can also add the railage inward. Carriage inward is when goods are coming into the business. The cost of those goods coming into the business, what you paid for the transportation of goods coming into the business is what you call carriage inward. Then you can also add the railage when goods are being transported by a train or something, railage. Then you can also add freight if the goods are being transported by a plane or a helicopter, freight charges, or freight on purchases. Then you can also add plus custom duties. Custom duties. Then you less closing inventory or closing stock. Closing inventory or stock. So if you got your opening inventory, then you add your purchases, then you add your carriage inward or railage or freight on purchases, then plus custom duties, plus import tariffs if you do have import tariffs, import tariffs. All this, you add them together, then you get your net purchases. Net purchases from your net purchases, then you deduct your closing inventory for you to get your cost of sales. Cost of goods sold.